Here again with smart system. In our last lesson, we looked at the role of the private sector and government regulation in the economy, and how each of these relates to trading. In today's lesson, we're going to look at a second way, which the government influences the economy, and therefore the market, which is known as fiscal policy. So let's get started. Fiscal policy for our purposes can be defined very simply as anything related to government spending and taxation. Before looking at the fiscal policy, role of government and trying to influence the economy, first have an understanding of the business cycle. So that's what we're going to look at first. For a number of reasons which are widely debated, the economy goes through repeated periods of growth and contraction over time, which can be broken down into the following phases. A contraction where economic activity and growth slows and can turn negative. A trough, where the economy stops contracting and a new expansion begins. An expansion or the speeding up of economic growth. And then a peak, where the growth of the economy maxes out and begins to turn downward. We could spend many months going over and debating why this is. But for our purposes, it's simply important to understand that, while the timing and length of each of these phases has varied widely, that's very unpredictable. The above pattern does repeat itself over and over again throughout history. This is important for us as traders to understand, as different phases of the economy, or the business cycle, and changes in people's forecast of where the economy is in those cycles is arguably the greatest factor, which affects the price level of every market. Prior to the Great Depression, the US government had a pretty hands-off approach. In regards to the business cycle, they let things play out as they may. But since the Great Depression, however, the government has played a much more active role in the economy, with its stated goals being to facilitate full employment and price stability. To help understand each of these goals, in the balancing act that goes on between them, as they often conflict, let's look at how each relates to the different phases of the business cycle. During an expansion, we start to see more people employed, as companies begin to sell more goods and services, and need to hire more people to keep up with demand. So it's party time and the politicians are all smiles. During this time, as economic growth picks up, more and more people are employed, they're making more money, and so they're spending more money that they're getting from their paychecks. And this can cause prices to rise, which is something this is also known as inflation. Because of this effect on prices, the government's primary concern here will normally be trying to keep prices stable and inflation and check without hurting the economic growth. The two things they can do here in regards to fiscal policy to try and keep prices in check and inflation at bay are: number one, they can raise taxes, because by raising taxes, money is taken away from the consumer, who now has less money to spend, and helping to counteract the demand that's pushing prices up and causing inflation. Or number two, they can reduce government spending, which also has the same effect of pulling some of the demand out of the economy that may be pushing prices higher, and therefore counteracting that inflation that may be taking place there. So I'm generalizing things and making things much more simple than they actually are, just because it's important at this point that we just have a basic understanding. So these things are pretty complicated, and we're going to learn more and more about them as we go into more and more the fundamentals of the diffs. In general, this is how things work. It's important to keep in mind that it is a little more complex than I'm making it. During a peak, when we start to see employment and the amount of goods and services produced and sold by companies to begin to level off, at this stage, the government normally becomes more concerned with preventing a deep contraction. And you can see here there's a little bit of concern on the politicians' face, because they can see that the growth is starting to level off and maybe heading towards a contraction. So at this stage, the two fiscal policy tools that can be used to counteract and hopefully keep the economy from going into a contraction or recession even, or they can decrease taxes, so do the reverse there, which puts more money in the consumer pockets. In the consumer's pocket is gonna increase demand. And this is what we've seen recently with the PAC stimulus. the rebate checks that we're all going to be receiving soon from the government as part of the stimulus plan, where they can increase government spending so they can start new projects like roads and spend more on education and defense and things like this, and add demand that way. During a contraction, we start to see employment and the amount of goods and services produced and sold by companies start to fall. The fiscal policy tools that the government has at their disposal here are the same two as mentioned in the peak phase, which are to reduce taxes or increase government spending. Things just become a little more urgent because the economic growth is actually started to slow or even contract. At this point, although there are exceptions normally at this stage, inflation is not a concern as demand is falling. So the government can be more aggressive than they can during a peak there. There was one exception to this race fairly recently, in the 1970s, where you had large inflation, along with slow and gross, something known as stagflation. And you can see how that would be a problem from a policy standpoint as far as what to do there, because you're sort of caught between a rock and a hard place. One other thing that is a potential concern during this time is something which is known as deflation, which is where prices actually begin to fall as demand is reduced, and this can be a large problem, which sets off a deflationary spiral where businesses slower stop investing because the investment risk is perceived as higher than just letting the money appreciate due to the deflation. And that can be a real problem from a growth standpoint, because we need these businesses investing and people spending to keep the economy growing. During a trough, we start to see the employment level and the level of goods and services produced and sold by companies start to level off again, and during this phase, the expected action, if any, from the fiscal policy side will be to begin to reduce whatever policies have been put into place and help the economy grow as it moves into another expansionary cycle, and the cycle repeats itself. While many believe that fiscal policy has shown to be an effective tool in regulating the business cycle, as government spending and taxation must be approved by both Congress and the President, managing the economy through the use of fiscal policy is normally seen as a lot more tedious than the second tool that government has at their disposal, which is something known as monetary policy. And this is going to be something, or this is going to be the topic of our next lesson. So we hope to see you then. If you have any questions or comments, please feel free to leave them in the comment section. Have a great day.